Good evening, guys. Ken at Tortoise Capital, nightly strategy podcast for December 1st, 2021. A tale of two markets today. So let's see what happened. Our 10-day range has now expanded to almost 5%. So yesterday we had the big sell-off that collapsed, and then we said that would create an opportunity to break out either to the upside or to the downside. And of course, what we got was both. So let's see what happened. Zoom in on this just a little bit more. So when we look at yesterday's close, what we had today was a big gap up to yesterday's VWAP, right? And so that was a really positive move, you would say. There was a lot of overnight buying pressure that made that a strong move up. And then it kept going. It went through the Bollinger Band mean, into the dragon, across and exceeding yesterday's high, which makes this really good. And it crossed the spine of the dragon. And then it topped out here early in the day. And then kind of went sideways a little bit. And then started to decay back to the open. So it on the way down, it's starting to get some weakness. So I call that yellow. Crosses the Bollinger Band mean, and then gets to the open. So that is also, at the time, that was the low of the day, right? So what that would have looked like if we were looking at a daily chart at the time, we would have seen, we wouldn't have seen this big sell-off. We would have seen that. We would have seen a gap up, strong move up, and then collapse back down to the open and a low of the day. And then it starts picking up negative connotations as it's making new lows. And then it breaks through the daily VWAP, or in this case, the new low of the dragon, I should say, breaks through the baby dragon, continuing to, it's horrible, horrible, horrible. Breaks through the river at Z-1, breaks through yesterday's low. So if anything, you could say that should be even a stronger red, when it breaks below yesterday's low, when it breaks through the Z1, when it made a new low of the day after a big gap up, that's sort of a rejection of all that goodness. And then continues to keep failing. Ooh. All the way down to Z2. That's how far that went. And then closed with a fractional little bounce in the last moments. So this thing went from above Z0, halfway to Z1, and then two full standard deviations down to the low of the floodplain. That's painful. So this really was the tale of two markets today. Reasons to be interested tactically on the way up, and then failure to follow through, and then gaining weakness. And then at this crucial moment here, when that gets rejected and starts suffering, then you're allowed to pick up a downward bias. And so the net for the day was down, I think it was like 1% or something here. Low to, close to close, it just looks like that, which is bad enough. But really, this was a 4% sell-off from the high all the way down to the low. And we talked about that yesterday, that the expanding ranges on downward moves are normal. That's the climb up the steps, fall out the window. That's the collapsing dragon all over the place. When you feel those kinds of days developing in this kind of market with expanded volatility, collapsing dragon is your friend. All right, let's take a look at the sectors. All right, so the S&P was down. What on the surface looks okay, just a down day, -1%, but really that hides the 4% sell-off that was from the peak of the day to the low. The intraday travel was enormous. It had to move up 3% and then fall 4% to end up with a net -1%. So the road was well traveled today. The best symbols today, emerging markets, oddly enough, up a third, 0.37. Treasuries up a half. Now they're at 152.34 and looking strong. The treasuries are now on a daily summer. That's how good that is. Diamonds were off 1.3, the Q's off 1.7, and the Russell, broad measure of speculative health, off 2.25. All right, let's see what was better than the S&P today. Not much. Finance, energy, materials, all off about 1%. Blended commodities, 0.87. Consumer staples, 0.5. Agriculture, -0.15. Lumber, 0.17. Mexico, which we saw yesterday, we highlighted as something that was abnormally strong yesterday. It had a follow through to the upside again today. The other lumber, 0.73. And then the VIX at +7%, which sounds a lot, but it's only half of what it's been gaining and losing the last 3 days, when its travel distance has been over 15%. So today it was 7%, which is still considerable. So what should be on your, all of these should be on your radar for tomorrow, especially Mexico. It's a hybrid frog champion, swings really well. Treasuries for a defensive play. Microsoft was only off a sliver, and Apple only off a sliver. So there was, if anything, some slight flight to quality there. They resisted the sell-off somewhat. Materials, energy, and finance were not up strong enough. We're not much stronger enough to make that really a significant difference. But for what it's worth, they were a little better. All right, symbols that were the sectors that were worse. There's tech, S&P tech 1.37, Bitcoin 1.4, the futures, Brazil 1.6, lithium 1.8, consumer discretionary 1.8, oil 1.8, FANGs 2.7, blockchain 2.7, wheat and precious 3%. So oddly, the precious metals are not acting as a safe haven. that's driving people to crypto and treasuries, actually. Bitcoin 3%, the Bitcoin Trust. Simon Property Group is commercial real estate 3 1/3. S&P Bio 3.6, marijuana 3.8, oil exploration 4%. We're going to see that trade in a minute. Moonshots 4.5, Arc Genomics 4.5, clean energy 4, almost 5. We're going to see that trade in a minute. They were just getting clean energy and XOP just got smashed today. So Arc Innovation 6.7. Individual companies now. Robinhood 7.7. Virgin Galactic 7%. Squarespace, Coinbase, Alcoa 6%. Tesla 4 1/3. Still holding above 1,000, but the shine is off the apple. The large cap blended crypto 4.3. Cliff, Ethereum, and PayPal 3%. Devon Energy 3%. So energy sector got smashed a lot today. So here's a symbol. I want you to notice that, you know, during the morning, gives us a little Kata 2. Nothing wrong with the Kata 2. By this time, with that double bottom, that's about where you want your stop. If you haven't exited, you know, up in here, or here, or I should say, or here, you know, there's 3 opportunities to get out of that with some fractional gain. You have to get out by the time this thing scratches at the VWAP, because if you let that get all the way to the VWAP, then you scratch, but then you've got a Z3 pinch breakout to the downside, which is legit. You know, by this time, you got to say, okay, clear, new low of the day. I've got, you know, 1 or 2 are in hand. Why not? Probably cover at the sniper. You might have taken that one and then scratched, and then collapsing dragon, either there or down here. You got to be prepared for either one of those trades. You might have now taken another bite. So now what you've got to clear. The energy sector is getting crushed. Oil is failing. And, you know, by this time, you've probably got a scratch trade and then a short here, another scratch trade, big win. Collapsing dragons all over the place. XOP, oil and gas exploration. Another symbol that is oscillating into a sideways quiet channel and a Z3 pinch. So you just frame it as a Z3 pinch breakout. And whichever way the breakout is, use the yellow box as your risk. So you're long. You decide where you want to exit. Not going to lose money on that trade. Probably there. I'll take that one. Or any one of the or the managerial exits in here. Yeah, might you have taken this managerial exit after your breakout entry here? Sure. If you're doing that, then you have to get long by here again, don't you? That's either a COTA 2 or a Z3 breakout or a new high of the day. Easy. Bollinger Band main. COTA 2. And then this one probably scratches. You might have even tried that. And then taken your loss like a man. So find the movers. That's treasuries. That's going to work again tomorrow. Yeah, Richard, you could, if you want. If you're going to, the COTA 2 failure is probably a collapsing dragon. If it is, then OCO is fine. Could we cover that in the hybrid trading course and the foundations course in detail? Have you taken either one of those courses? Okay. All right, here's this is TQQQ. That's the triple X. Yes, Richard, the foundations course is a 10-week course with over 100 hours of video lessons and feedback. So what we have is we have the gap up, and we have a COTA 2 formation kind of forming here. Get the RLX. This is a good effort at going short. This is a good exit. This should be a stop and reverse, followed by a standard sniper exit here. Would pay for the fractional loss here. This crossing of the Bollinger Band mean either at here or a breakout below the river or below the Z2 or below the Z3. Each one of those is a signal to go short with a cover here. That's a big payoff. This is another collapsing dragon, collapsing dragon, collapsing dragon. What you're looking for is these lower highs are telling you that the breakdown is the trade. Get the market call right. Let's see. Steve shared a couple things from a trading mind journal or something, mental preparation and a journal that he's using. Looks reasonable. Looks something like what we do with our daily after action review and across a couple pages. That's a way to do it. Here's Luke with CLF. So there's the gap up. It sells off briefly and then resumes. He gets the RLXD. Cashes a win. This is a reasonable effort of the short. Good exit, good scratch, good micro, and now here's a collapsing dragon. Second position on a Z3 breakdown. This thing was probably an extra R in hand on two positions, and we let that one scratch. So we left some on the table there, but this is a great re-entry. Now, I want you to notice again, a high on the hump of the dragon, a lower high, another lower high. That makes this one massive good to the downside. He gets that one, he gets this one. Good scratch. Great re-entry. We're letting a lot get away. Letting a lot get away. But good re-entry. Letting a lot get away. And that's a good capture. And that's 4.5 R on the upside on a symbol that lost big time today while the market was in massive pain. So well done. You're noticing Luke make 5 R on a day when the market is down. He makes 5 R on a day when the market is up. He's finding the movers, getting in line with the direction of the day and trading to control his risk. And he's not over optimizing here. I mean, there's room for improvement too. So there's a lot of goodness in here. Keep working. Riot, gap up, catches the wave, held at the spine of the dragon. It didn't even get to the VWAP or to the PSAR. Good scratch or a plus 0.02. Held support above the Bollinger Band mean. Buys the breakout. Where is our scratch? Where is our exit? Or did we stop in reverse? I don't see the exit. This may have been a stop and reverse. I'm not sure. That would explain that. But here's our Kata 2. Another Kata 2. Here's the routine exit. Now I want you to notice the peak of the RL10, a lower high, PSAR flip. There's your short. That's also a collapsing dragon on that RL10. Here's where it crosses the VWAP. That's a big signal short. Here's where it crosses the RL270. That's a signal short. Here's a cover. That's another lower high. So that's your short on the PSAR flip. That gets paid. This one gets paid. You keep looking for places to find support. the whole market was getting smashed. Find the movers, get in line with the market direction, and crush this thing. Watch your directional bias. All right, let's go to dashboard 1. So the market moved into volatile conditions. We're still in bullish conditions because we are 5% above the 200-day moving average. So we're still bullish, but it's red bullish, meaning that this range above the 200-day moving average is one of the worst that we have seen. And let me explain that again. How this works. So we track price relative to the 200-day moving average. So let's call that the 200 DMA. And then we go back 180 days. And then for each one of those days, we check to see where the price was. So we're measuring that distance from the 200-day moving average to the price, to the closing price. And then there's that's some percentage of stretch. So if we were to, draw that line, where's my annotation? There it is. So when we draw that price line in there, what we would say, this stretch from the 200-day moving average to that price, that would be the maximum stretch percentage, right? And then this one was probably the minimum, and maybe that's pretty close too. So we compute that percentage stretch each day. And then for the last 180 days, we find the max, the min, the average. We compute the standard deviation, whatever that size of a standard deviation is. And then we say plus or minus 1 standard deviation. We color code that as green. It's about 1/6 of the data falls in there. If it's more than 1 standard deviation below, we code that as red. That's about 1/6. Then there's about 1/3 and 1/3 of the data between average and average plus 1. And then there's 1/3 of the data between average and average minus 1 standard deviation. So 2/3 of the data is found within plus or minus 1 standard deviation. That's what we mean by the z-score. So if it was exactly 1 standard deviation above the average, that would have a z-score of 1.0. If it was exactly 1 standard deviation below average, it would have a z-score of minus 1.0. If it was exactly on the average, it would have a z-score of 0. So when we color code, we're looking at green, white, yellow, and red. So green, white, yellow, and red gives us a little traffic lighting condition. So now when I see this thing is today 4.96% above the 200-day moving average, that means it's bullish because it's more than 2% above the 200. So that's bullish. But that score is so weak, 4.96% is so weak compared to how far it used to be stretched, that it is in the bottom 1/6 of the stretches of the last 180 days. That's why it's coded as red. So this is like this is a warning condition that says, even though technically we are bullish, this is really about as bad as it's been in the last 6 months. So it gives you an extra insight about the nature of the market condition. That's what that color code means. Okay. ADX is 26.5. That is strong, and the price move has been down. So this is a bearish short-term trend. And then the ATR is now 1.23%, and that's volatile. And that's why this is in the volatile condition, because it's more than 2% above. That's why it's bullish, and that's why we are in bullish volatile. Now, the risk Z and the risk index are showing a Z score worse than -1. So that is abnormally bad in terms of the volatility trend. So that's how you read that little piece of the chart. Okay. You'll note we are only overbought on the 270-day look back. We are middle of neutral here on the 90-day, and we are significantly oversold on the 30-day, 10-day, and 2-day look backs. Again, you can see us using that traffic lighting to give us just a quick assessment of what's going on. The S&P and the Qs, both firing on channeling rules. Pfizer, Procter & Gamble, United Health on the min pains. Oil, natural gas, oil exploration, retail in the max pains, Alcoa in the max pain. So that's a candidate. Treasuries on the min pain. And these are all bonds and income funds. Lots of channelings today, tons of auto framers that test out well, lots of 5DDs in the Dow tactical summary. Lots of channelings, lots of auto framers in the ETF tactical summary. Big breakdown here in Asia less Japan and in finance, both areas of weakness. Tons of setups in the auto framer, but this is not a market to be swing trading. This is a market to be intraday trading. If you were going to swing trade, this defensive plays would be the place to go, like treasuries. No squeezes today. None are better than 2-to-1 because of the size of the daily range. You're not going to find. That's the opposite of a squeeze. And you can't even see SPY on that. Oh, there's SPY way down at the bottom. Only treasuries in the summer. Pfizer and Apple in the summer here, but otherwise the winter is dominating the ETFs and the Dow. All that red, that's telling the story. Only treasuries. And really, Mexico was the only other thing that wasn't just an absolute train wreck today. Pfizer and Apple were the anomalies. The dragon waking up and is hungry. Now the slope of the RL30 has gone below the long-term average in terms of Z-score and is now approaching negative territory. It's about ready to roll over and go negative for the last 30 days. Very close. This is why, look at the stretch, the S&P stretch compared to the 200. That was the little briefing I gave you before. This is already 2 sigma bad, minus 2 sigma. On its best day back here, this thing was 2 sigma to the good and has done nothing but collapse once, rebound to the average, and then collapse twice. So this thing is about ready to get really ugly. Remember, this thing's only 5% sell off. And during the initial COVID panic reaction, it was off 35%. So we haven't seen anything like panic yet, but this is what the first couple days of one might look like. Volatility just got above that Z1 line, so that's why it's now volatile. Has collapsed below the river. And just one collapse below, even if it recovers, there can be a second leg down too, as we've seen before. So not out of the woods. All right, that's everything we got for today. Lots of work to do tomorrow to be ready, to be prepared. So we will get this published and posted and see you tomorrow. Locked and loaded, ready to play.